I know like we all have, maybe fairly different ideas of what is risky or not. So, this might be a kind of a hot take, and you guys might be like, what are you smoking? But I think, in my opinion, if you were to ask me what I thought about my own risk tolerance, I would actually say that I'm risk averse. And I know you guys are like, what? Like, what are you talking about? Like, how are you risk averse when you're buying so much stock in Bitcoin and Bitcoin miners, right? And the way that I approach risk is I think of risk not just as volatility, right? So I think of volatility as only one aspect of risk. And what I mean by that is that, yes, it is risky if, let's say, you buy Bitcoin and then you need the money a week from now and then Bitcoin drops 30%, right? Like that has happened multiple times. It's happened so many times that I can't even count. However, uh, but let's say you're invested in like a bond that pays 2% and it just consistently pays 2% every year, and it doesn't, like, it's a bond, so it doesn't really go up, right? Like it's a what we call a GIC, guaranteed investment certificate, or I think Americans call it a CD. But yeah, let's say if you're invested in such an instrument that just consistently gives 2%, and it never goes down, it only goes up. But you're if you look at the inflation rate, it has, like, if you look at CPI, sometimes it's below 2%. But if you look at anything that people actually want to buy, like, groceries, or like post-secondary tuition, or like housing, all of those have gone up much more than 2% per year for a really long time, even before the pandemic, right? So if you're stuck in such an instrument that only pays 2% per year, then you're losing real purchasing power, meaning real as in, like, as opposed to nominal, right? Like if you adjust for inflation, then you're losing real purchasing power over the long term. So I think that being involved in an instrument that is chronically underperforming, that is a form of risk as well. So, uh, kind of my investment strategy and my investment thesis is to balance those types of risks, right? So, I want to get real capital gains, and at the same time, I'm willing to sacrifice on the volatility front a little, because I'm fortunate enough to have a good job with a decent income where I, probably, like, won't need, $1,000 by next week, or else I'll go hungry. Like, I'm not in that situation, fortunately, right? So I can afford to take a little bit of risk in the volatility front, and in turn, I kind of decrease my risk a lot in the chronically underperforming part of the risk spectrum. So this is kind of my approach to risk, and after I've analyzed everything, I think that at this point in time, with such a good news coming out of the Bitcoin space, uh, putting a large amount of money into Bitcoin is actually the least risky bet I could take, and that's why I did it. So that, again, that's a hot take, but I throw it back to you guys. What do you guys think? Am I crazy, or does that make sense?
Um, this is like outside of the podcast, but so we have a group chat with like the
Mhm.
three of us and a few other people talking about personal finances and the stock market on a daily basis. I think you shared a chart of the comparison between, I don't know, let's just use my example, VFE versus Bitcoin in like a long period of time, and you can kind of consider it as like a what's the word, like a compound interest investment, like in the long term it does, like, if you really think about it, outperform VFE and a lot of other stocks. So I totally defend and like see where your vision is and like what you're doing. It's just that I guess for me, it's like high risk, high reward. I might be too much of a insert cat photo. We'll keep it PG, but it's like you'll win $1 million. $1 million is like behind me, for example, but like for 1 minute, you have to tie yourself to a rope. Three people have to hold on to you, and you have to lean towards a cliff. That's dangerous territory. It's like if you come up, yeah, sure, you get the $1 million, but you could fall and you could die, you know, like that's just me.
That's an
But like,
oddly specific example. It sounds like you were in that situation personally.
no, of course, no. Like, I'm insert cat photo B-roll, but like, yeah, like I don't know. I guess go big, go home. Like higher risk, high reward. But dang, yo, I'm too much of a cat photo. So, but like, don't get me wrong. I'm in it. Like I've said before in the other podcast, but I'm definitely in like bit farms. You know, Bitcoin, Ethereum. I've been lazy on Solana, but I should dollar cost average on that too. Like I'm losing it like by not doing that. But yeah, no, I totally respect it. Yeah, go for it for sure. So
Mhm. Tristan, thoughts?
I think something to reference from what Andy was kind of getting at. I think that most people tend to dramatically undervalue the risk of inflation as well in that analysis. Like, so for your example of the 2%, um, the 2%, most people would look at that and go, "Oh, I'm going to have 2% more money after the fact." But with inflation, which is a minimum of 2%, because that's what the bank targets, the Bank of Canada, the Fed, all of them pretty much target a 2% inflation rate. That means that with a 2% interest, you will at best keep your money worth the same in purchasing power, and at worst lose money, lose purchasing power, which is basically, what's the point on that front? Like, I feel like I would rather invest in something that could have higher gains than that, even if it's the S&P 500 over that. But I think that on that front, I think so. For example, like with Bitcoin in particular, I think that Bitcoin has a lot of value from a store of value perspective, and I think that that is where my my mentality of this is a good place to park some cash comes from, because of the fact that as long as you are purchasing it not at the very peak, you will be making a pretty good amount of income, like net income, like interest grown from it, with, in my opinion, like a lot lower of a percentage risk. So for example, like if Bitcoin goes up, so for example, like my Bitcoin has gone up significantly. The 2% risk on that money, like the inflation risk on that money would have been a much smaller portion of it would have been eaten into, for that purchasing power would be eaten into it from a inflation perspective. Well, a significant amount of that then is now an actual gain in the interest, whereas with a lot of the other investments, the real gain is significantly lower, and so there's a risk to being involved in stuff where that have a lower return, because of the fact that you will be placing yourself in a scenario where a lot of that return is being consumed by inflation, and thus you aren't actually seeing much of a real return. And that's why Bitcoin is kind of an interesting opportunity. And I think that that's what one of the reasons why I'm personally so bullish on it.
Yeah, it's opportunity cost, right? And yeah, you brought up such a great point that I think this is why I'm so bullish on Bitcoin is like, you know, if us plebs can realize the fact that even a small amount of Bitcoin can make a huge difference in our portfolios, then professional money managers will probably realize, if not already, and they'll probably catch up, right? So I believe a couple of episodes ago we had that story about Wealthsimple, where their managed portfolios was chronically underperforming, even just like the general stock market. Well, my argument was that if they had just added 5% Bitcoin to every portfolio, then just watch the difference, right? Like my estimate, I haven't run the actual calculation myself, but my estimate is that they would outperform most, if not all, managed funds like mutual funds and stuff if they just added 5% Bitcoin to everything, right? So that's kind of point number one. And like, and if every fund manager does that, like, you know, Fidelity has what, like 3 trillion of assets under management, BlackRock has like 10 trillion. So like if everyone just adds 5% of their AUM, including these big institutions, then, you know, we could easily see, you know, 500k, $1 million Bitcoin like very soon, right? So that's kind of, yeah, point number one. And yeah, so point number, I had another point. Point number two was, um, yeah, just about risk tolerances. I think that one of the most harmful things that we teach people when they first get into investing is that volatility is the devil, right? So, you know, we kind of taught a whole generation, maybe there's more than one generation of retail investors that you should avoid volatility, and I think that that has people have paid a lot in terms of opportunity cost because they're afraid that, you know, they're afraid of the volatility of things like Bitcoin, right? And it's not just Bitcoin, to be honest. It's things like Tesla too, right? Like how many people never bought any Tesla stock because of how volatile it is? And if you never bought any Tesla stock, then you would have missed the 2019 to 2021 20 to 25x gain or however much it was, right? So I think that teaching people to hate volatility is really one of the cardinal sins of the investing world. And yeah, I don't think it should be that way, right? But yeah, let me toss that question back to you guys. What do you guys think? Like, you know, is volatility bad, or should we focus on other aspects when teaching people about investing for the first time?
Well, I think like bottom line, I guess it's like depends on everyone's situation. I guess it's called personal finance for a reason, but I think we're three responsible fellows. So I think on behalf of us, or at least myself, I'll just say on behalf of myself, volatility is like reasonably okay. Like if you're like prepared for it. Me personally, I like having an emergency fund. I know you guys are more YOLO than me, but I mean like if you're like in a good spot, yeah, I think volatility is pretty reasonable if you know, fundamentally, as Buffett says, believe in the stock over like a 5 to 10 year period of time, then yeah, it's fine. But I guess like we believe in Bitcoin too, so like it eventually will go to 100k, I'm sure. So I think we'll still continue to buy. Not financial advice, but yeah.
Mhm. Tristan?
Yeah, so I think that people psychologically volatility really affects how people think about stuff. So it's really hard for a lot of people psychologically. You have to kind of build up resilience to the volatility, because I think when people first start out, you see something spike up, you know, suddenly, and you're like, oh yes, and then it goes down a whole bunch. You're like, panic, right? So I think that a lot of people haven't built up that kind of just sit and, you know, be reasonably relaxed, you know, and believe in, you know. And I think an important thing is that a lot of people don't understand what they're invested in. And so if you don't understand what you're invested in and you're seeing a lot of volatility, then your confidence, you're like, oh, did I make a mistake? Did I do something silly? Like why is it going up? Why is it going down? Why is it down further than it was when I bought it? You know, I'm losing money on this now, right? So you've got this whole psychological voice in your head going, with the doubts going, you know, why is, have I made a great mistake? And then the only way I think to get really to handle the volatility is to kind of build up some resilience to it, to the psychological voice, and be like, no, like, yes, we're down today, but I believe in what this stock is, or what like Bitcoin is, or for example, and I believe that it's going to have a significant of value in the future, and I believe it's going to represent a lot of value in the future. Therefore, this current volatility is just noise, right? And I think a lot of people also don't take into the fact that volatility can be extremely useful, because if you have something that's very volatile, you can take advantage of a lot of the ups and downs if the stock is behaving volatile. Like for example, with the Bitcoin miners, they spike up and then they spike down. If you buy while it's down, sell when it's up, and then buy again when it's down, there is a lot of money to be made in that swing trading environment. And from my perspective, at least with the Bitcoin miners, is that we're not currently at the peak for what I think that they'll be worth. So best case scenario, I do a swing trade and I get a bunch of profit. Worst case scenario, I hold it and it shoots up and I get a bunch of profit. So I think when you've got stuff like that you have a lot of confidence in. So and another example in that regard would be like Tesla. If you're like looking at Tesla and you're like, I know Tesla's good. I know Tesla's got a great product. I know Tesla's moving in a path that I like to see. You can go and look at it and be like, well, Tesla went up. Tesla's now down. I still believe in Tesla. It doesn't matter if Tesla is up tomorrow or down tomorrow, as long as 10 years from now Tesla is up, or however long the time frame is that you're looking in, the Tesla is still up. So I think a lot of people underestimate or overestimate the issues with volatility. But at the same time, I think that it's also not wise to underestimate volatility.
Yeah, I guess my point was just I kind of want to encourage people to just like be a little bit more like have a higher standard for your money managers if you are going to trust someone else to manage your money, right? Like if it's yourself, then it's, whatever, make your own decisions. But I know a lot of people, so back to the Wealthsimple example I gave earlier, where, I bet there's a lot of people who's using Wealthsimple managed portfolios who, put a large sum of money into the managed portfolios, and then they get, let's say, like a 5% rate of return a year, right? And then meanwhile the S&P goes up by like 8%, and then they look at their Wealthsimple portfolio and they go, "Oh, that's great! I have more money in it now than I did when I started, and because it went up 5%, so I have 5% more money. That's great. You guys are doing a great job." Like, I think that's how like most people think, right? And I think that's wrong, because we should have a higher standard, right? Like we should demand that our money managers at least match what the market is doing. Because like if you're in an index fund or if you're in a managed fund and it performs the same or worse than an index fund, then it's like, why am I keeping my money with you? Right? Like it's because managed funds often have higher fees, right? I know Wealthsimple is known for being one of the like managed funds with the lowest fees, and even they charge I think it's like 0.4% or 0.5%, something like that. And like the Vanguard index funds charge like basically nothing. Like I think VOO charges like 0.08%. Or do they like make it free? I don't They have a lot of ones that are just absolutely free. Even if it's 8 basis points, it's like nothing, right?
Yeah. And friendly reminder that if you want to be in the Wealthsimple managed fund, but you don't want to pay the fee, you can always just buy the ETFs that they own, right?
Yeah,
like
but
their ETFs that they purchase for their managed portfolio are public knowledge, right? You can just look at what's in there, and you can just, if you really want it, just buy it yourself and save the 0.04. That's another, that on top of inflation, that's another little bit of savings you could do.
Yeah, I mean, I guess with that one, I can like kind of maybe see a little bit of value, whereas like you just put your money in and then you forget about it, versus like, yes, you can save 0.4% if you just go out and buy all of those ETFs yourself. But I think that there's a lot of them, right? There's like literally like 40 or 50, if I remember correctly. There might
For
even be
Wealthsimple?
like, yeah. Aren't
No,
there like 50
there's like
ETFs?
10. There's like 10.
Okay, well, it's a large number, but
Yeah,
like,
there's enough that I put them all on my spreadsheet without feeling like I was doing a full-time job.
yeah, I mean, it is kind of maybe a hassle to go out and buy like 10 different ETFs, even if it's only 10. And then like, it's also like not every platform allows for fractional exposure. So you're not going to be able to invest 100% of your money if it's not fractional. So it's like, if things change, do you rebalance, and then you have to rebalance it yourself. So I think for that, I do understand the value in Wealthsimple's managed portfolios, but it's just the performance is not up there, as we discussed in one of the previous episodes when we went over this, right? And it's like, I'm disappointed on behalf of their customers, and I'm not even a customer of the managed portfolio. I'm a Wealthsimple customer, but I use their self-directed platform. I'm like embarrassed on behalf of like their customers and their advisors, where like, what are they paying these advisors for? And these advisors, they make a lot of money, right? So like, what are they paying these people for if they're like underperforming, like not just like an index fund, but even other mutual funds, right? So it's very disappointing. And I've added them on Twitter or X or whatever it's called. It's like, hey, Wealthsimple, you should add Bitcoin to your portfolios, and then they just ignore me. So yeah, thoughts.
Thoughts?
They're
Well,
not.
like sorry, I'll just say something real quick. Like I remember from that podcast from like a few weeks ago, was it? There's like three different options. You can argue that the third option, which is the most volatile and risky, could have Bitcoin, and maybe the more safer one wouldn't, as like a baseline to get people more introduced to it. But yeah, I guess it's quite disappointing. You might as well just buy like VFE or something instead. You'll probably do better. But
You probably would do better. But I think it's also important to remember that the managed funds do have some safer stuff, and the safer stuff does insulate in regards to big fluctuations. So I think that a lot of it comes down to people not being comfortable with the idea of seeing their account have big moves, right? So I think those like fixed income, gold, all those other things, those basically are acting as insulators to prevent you from seeing as much volatility, because they should have the inverse reaction of the stock market, right?
Yeah, I mean, so I guess like for me personally, and I know I'm like super biased because I know this might come off as me being like, let's say I'm a race car driver and I'm like yelling at a 16-year-old, and it's like, why can't you drive? Right? Like it's so easy. But like, yeah, I mean, it just for me, I I do want to encourage people to have higher standards for rate of returns. That's number one. And number two, I want to encourage people to be more tolerant of volatility, because volatility can be your friend. And volatility is not the devil that we've been taught that it is. So those are kind of my main 2 points. And I just want to make sure that those come off clearly. But yeah, I totally agree with what you said, Tristan, where it's like, yeah, there's certain scenarios and there's certain purposes and there's certain types of people that maybe like Wealthsimple managed portfolios would be the best product for them. But yeah, I mean, it's hard for me to put myself in those shoes, but maybe I'm just too YOLO. So
I mean, to add to as well, if people are so afraid of volatility, I think that's also like an indicator that you need to do a bit more due diligence in like what you're buying. Because if you're not comfortable with that purchase in the first place, I think we have problems. I feel like I've learned that the hard way for a few stocks. Unfortunately, Neo. Anyway, let's not talk about that. And number two, I think if you're also worried about volatility, it means like you probably should be saving more money for like emergency situations. You might not have the best financial situation, possibly debt. I don't know. So maybe fix those things first. I know maybe some of us are anti Dave Ramsey, but at the same time, some of the things he says are like pretty reasonable. Not so much the credit card stuff, but yeah. like snowball effect. Maybe look that up. But yeah, my thoughts.
Yeah, I mean, like quickly on like Dave Ramsey, obviously I disagree with him on a multitude of things, but I think that everybody has bias, right? I have bias, and I can tell that Dave Ramsey has a lot of bias because, like, you have to be right because he deals with just people who are absolute trash at managing personal finances on a daily basis. And it's like, yeah, people calling in and be like, hey, I'm like $500,000 in debt because, I go to the casino every other week. And, it's like I remortgaged the house and went to the casino and I lost it all. Like, he's dealing with people like that. So obviously you're going to be like, hey, like, don't have credit cards because it seems like all these people ruin their lives by like overspending and maxing out their credit cards. And it's like, don't buy Bitcoin because somebody bought like Doge Elon Mars and lost all their money on some random like dog coin. So that's why Bitcoin must be the same, right? So don't buy Bitcoin. It's like, yeah, I can tell that like, a lot of the things that he says might be catered towards one specific type of personality, i.e., the people that call into his show, and it's a combination of also his like lack of understanding about Bitcoin in general, that he's very anti-Bitcoin as well, and I can maybe see like where he's coming from. Like that doesn't mean that I think he's right. I think he's wrong, but I can see where he's coming from, right? So yeah, I just think that there's a multitude of opinions. I've provided I've provided my own opinion, so it is what it is what I always say.
I don't know, man. Use your credit cards properly. I'll say that. Don't believe in everything he says. Get those points. Honestly, be smart though.
Just pay off the credit card.
There you
Funnily
go.
enough, credit cards are super great as long as you just pay them off in full every time.
Savage mode on. Just don't be acoustic, okay?
No, the credit
Come on,
cards
guys.
are absolutely great. I have like 15, and it's like, my credit score is stellar.
We love that, honestly.